Hi, this is Jim Denholm, founder and CEO of Ironbridge Private Wealth. We're a registered investment advisory firm in Austin, Texas. Welcome to the Strategic Growth video podcast. This video series is called The Big Five. Each month, we'll focus on 5 themes that affect your wealth and your investments. And this month's focus is on how COVID may or may not impact financial markets. So let's go ahead and get started. So let's talk about COVID cases. We're going to talk about the S&P 500 relative to COVID, talk about Treasury Bonds, do some cross asset analysis, and then talk about the Fed briefly. But no surprise, if you've been living under a rock over the last 2 months, you haven't noticed that COVID cases are back on the rise. This is the Delta variant. So if we look at the overall pattern of new cases since the pandemic started in early 2020, we saw an initial surge here. This is where the market was really affected, that we'll talk about in a minute. Tests were not very good, so it's hard to tell exactly how many cases were really there. But we've seen this sort of pattern of a first wave, a second wave, this really big wave last winter. We were hoping that things were behind us, and here comes the Delta variant. A couple things to note on the Delta variant: hospitalizations are pretty high. This is a pretty accurate data for the most part. While I think there was a lot of under testing early on, there were still pretty good data around hospitalizations. The Delta variant is causing a number of people to be hospitalized. We're seeing that in Austin with ICU capacity almost at zero. But the number of deaths have not been anywhere close to what these previous surges have been, which has been good. But over the last couple of months, we've seen an increase of new COVID cases of more than 100,000 per day. So this is really having an effect. One of the things that we've looked at that I think is interesting to look at is the UK. So we're going to talk about the UK and some other variants, but UK had a similar pattern. We saw an initial surge, a couple little waves up into the peak. Again, saw a big decline in cases, but about 6 or 7 weeks before Delta showed up in the US, it showed up and started to wreak a little havoc in the UK. What we've seen over the last month or so is that the new cases have really started to fall. Gives us a little optimism that maybe we're getting close to the initial this initial wave of Delta in the US. The main question is this a peak or a pause? When we saw a couple different pauses here, it could be very similar to what we saw in November in the UK, where we saw an increase in cases. It paused a little bit. We saw a decline in cases, and then this surge into the ultimate peak. So the cases have fallen. We've seen this. Is it a peak or a pause? That's the big question. But I think we should be watching the UK for some clues of to what we may want to expect over here in the US. Next chart looks at the different variants. So each gray line is an identified mutation of the original COVID virus, and you can see there are a lot of different variants. A lot of them started in Asia at first. If you look at this sort of aqua blue color, we saw the initial variant start to take place in Asia. In Europe and North America, we've seen a lot of these. So the US are seeing these different types of variants. This is your Delta variant and your Lambda variant that we're obviously all getting used to hearing those terms. There's a tremendously high number of variations. Now, every variation doesn't necessarily mean it's more dangerous, but it has been very interesting to see just how rapidly it has mutated into different strains. So a little bit unnerving which one of these might cause a problem, or are all of them not going to cause a problem. I'm not an epidemiologist, neither is anyone that we have at Ironbridge. But it does mean that there's a tremendous amount of variations out there that we might need to expect something happening. If we shift gears and look towards Alabama in particular, one of the things that we've started to see with this Delta variant that is concerning is that it's affecting people a little bit more negatively than in younger people than the original variant, the original COVID did. So this looks, for the past 4 weeks, this was as of August 15th, so July 15th through August 15th, cases, deaths, and the percentage of population in Alabama, a place that we have seen a massive spike higher due to the Delta variant. One of the concerning things that we are looking at is more younger people are testing positive, and deaths are the younger people are starting to have a higher percentage of deaths, where in the surge that we saw in last winter, 80 to 90% of deaths were occurring in people over 65. 56% of deaths are over 65 over the past month. So it's telling us that one of the consequences of the Delta variant is that it is starting to creep in and be a little bit more catastrophic for a little bit younger people. Fortunately, it's not necessarily affecting kids, but we are starting to see the share of deaths increase for those who are younger. So basically, go get vaccinated. The vast majority are vaccinated. So we need to be watching out for it. The question then is, should we expect COVID and an increase in COVID to affect the S&P 500 and affect the financial markets? So let's take a look. So this is a chart of the S&P 500. The blue is the S&P 500 from late 2019 through basically a few days ago. And overlaid that is the 7-day moving average of COVID cases. The gray shaded areas are the periods where the 7-day average was increasing over a sustained period of time. So we've basically seen 4 kind of waves of COVID. What did it do to the markets? Well, the initial rise when COVID first started, that was really peak uncertainty. And as a result, we saw almost a 40% market crash in just over a month. One of the interesting things is that we really didn't see much, the market didn't start moving sideways. It didn't start to decline at all. It was literally at all-time highs, and it crashed. A very unique historical occurrence. Markets tend to not crash from all-time highs, but they did. As we've seen these subsequent waves, though, we have not seen a corresponding increase in volatility. So the second wave, last June, July of last year, we saw a tiny sell-off, 5-6% sell-off. Cases kind of declined, abated a little bit. We saw the start of this massive surge over the winter. Not much, 9-10% pullback, which is what we should expect once every 12 to 18 months. Didn't see much volatility. We also had a pretty contentious presidential election and all the craziness that was happening there. Not much volatility at all. So the fact that we saw this huge surge in COVID, uncertainty with the election, the Capitol riots and things here, nothing really affected the market since then. And if we look at this recent surge in the Delta variant, if we didn't overlay this to the chart, I don't think you'd even know that anything was really happening. So while COVID might start to matter from how the number of cases and the prevalence across society, it's obviously very negative, but it's just, there's just not a big correlation with what's happening in the COVID pandemic with how that translates over into market performance or market volatility. After this first crash, it's frankly has not mattered. And there has been zero correlation between increasing cases and how that affects the markets. What that tells us is that new cases, we probably shouldn't use that as a reason to go in and say, okay, we should expect additional risk in the financial markets because cases have been going up. That's just not an argument that makes any sense to us, because there has not been enough data to show that has any kind of correlation whatsoever. And let's put this context and move. Put this move in context. This was a massive rally off of these lows. And let's compare it to some other rallies. This is a pretty interesting chart. This is from LPL Financial, Ryan Dietrich, one of my personal favorites to look at and follow on Twitter. They have a lot of very interesting charts that they put out. And what this looks at is for the 7 major bear markets since World War II, how long it took to double off of the lows. So 100% return is a double. This dark blue line is the move since the intraday low of late March 2020. And as of a couple weeks ago, it had officially crossed the 100% mark, as of 8/16. That happened in just under 1.5 years. Put that versus the rebound following the global financial crisis in 08 and 09, it took about a little over 2 years to double. So this green line is the performance off of the intraday low in March 2009. As an aside, this low on the S&P 500, the level that it bottomed at was 666 in March of 2009. A little ominous, but so that means this doubled. It got to 1332, if I'm doing my math right. The longest that it took to double since World War II off of a major market low is the kind of sideways inflationary bear market from 74 to 80. And it took almost 6 years to have a 100% rise. Pretty amazing, historical rebound there. I think a couple things affect that. We'll talk about the big one, the Fed, here shortly. The other is that this was truly an exogenous event. This was not a housing crisis that was embedded into, some problems embedded into the financial system. It was not an inflationary environment, longer term inflationary environment with problems embedded into the economy and the financial system. This was an exogenous event that came in, wreaked havoc, and the Fed came in and started to build things up. And I think those two combined resulted in this pretty major historic move off of the lows. So it is not paid to be, the other thing we'll note, it's not paid to be very defensive since then. We talked to a lot of clients who have been holding quite a bit of cash on the sidelines and have missed out on this. We've had some periods at Ironbridge for the portfolios we manage that we had some additional cash, but that's been pretty temporary, and for the most part have been fully invested through this. So if you've been getting advice that you should not be invested, I would second guess that advice right now. So let's switch over to treasuries. Long-term treasury bonds tend to be a beneficiary of volatility. So if we see economic events, global events, COVID, things like that, there tends to be a move into treasury bonds as a flight to safety. And this looks at long-term treasury bond prices via the ticker TLT relative to that same 7-day moving average of COVID cases. So bonds have actually had a little bit higher correlation than with COVID cases than stocks have. And in fact, they started to move up. The lows here in late 2019 coincided with the first case emerging from the Wuhan lab. And what we saw is that starting in early 2020, before we had even the first confirmed case in the US, which happened on July 11th, 2020, which was someone who came back from Wuhan and brought it into the US, we started to see bond prices really start to move quickly higher. This showed up in some of our systems. We started to move out of some of the more aggressive areas of the market into some treasuries. But Treasury market started to anticipate this move, and it's been a little bit more in sync. So this first wave, it sort of anticipated it. Bonds moved first. These first two waves, as COVID cases increased, so did Treasury bond prices. It was kind of interesting to see that as we moved into the worst part of the crisis so far, and hopefully ever, but so far at least, as those cases were massively moving higher, bond prices were pretty consistently selling off. So we saw this correlation happen here. It didn't work here. An interesting thing, though, now is that bond prices started to bottom and move higher almost in a little bit earlier than when we saw the COVID cases rise due to the Delta in the US. Treasury bonds started to move more in line with UK. So as the Delta virus started to emerge in other parts of the globe, US Treasury bonds started to move higher. That would make sense because part of US Treasury buyers are not just US retail investors. They're not you and I sitting around in an investment portfolio trying to buy treasuries. They're sovereign debt funds. They're the Bank of China. They're massive moves, massive pools of money that can move in and out of treasuries. And this rise in treasury bonds has correlated a little bit more with the global rise in the Delta variant. And it started to hit here first. So 3 out of 4 of it's still a very small sample size. So you can't really take a meaningful statistical analysis of it, but 3 out of 4 of the waves higher we've seen in COVID cases has coincided with or treasury prices have been a little bit early in that move. So we do think that treasuries could be a little bit more valuable to look at when it comes to what we may or may not see as far as COVID cases. So if we started to see treasury bonds move lower, that could coincide fairly well with UK cases. We've seen this sort of drop here in treasury bonds coincided with the drop in the UK cases. But we also have seen these prices start to tick back up. But I think it's going to be a little bit better indicator to watch treasuries as opposed to the S&P. So what if we compared the two? There's a lot of value in looking at a relative performance chart. So let's talk about what this means. This chart is looking at the S&P 500 versus long-term treasury bonds. So this is the ticker SPY versus the ticker TLT. And when this chart is moving higher, it just means that the S&P is moving faster than treasuries. It doesn't give us an idea of the direction of the trend. Both could be moving up, both could be moving down. This is looking at the relative performance. So higher in this chart means that stocks are doing better. As this chart falls, it means that bonds are performing better on a relative basis. A couple interesting things that we've seen here. So stocks were outperforming bonds in late 19. And while the S&P 500 didn't give us any warning, we did see a divergence in stocks relative to bonds. So bonds started to outperform in the later months of 19, and especially in those early months of 2020. So this gave us a little bit of a warning sign. We had the market crash where bonds outperformed stocks. As expected, we saw in a historic bull run higher, stocks outperform bonds, and we're getting a little bit of mixed messages now. So we've started to see a divergence here as well. This also coincided with the Delta variant. A couple things we can take from it. One, the other cases, the two waves. Here's the first wave, the second wave, the major third wave. The stock bond ratio didn't give us a whole lot of information. We have started to see this divergence. It's coincided with the rise in Delta, but we've also seen a break higher out of this ratio declining. That also is a sign that when we combine the stock bond ratio and combine that with a drop in Delta cases, maybe we're getting closer to the peak or a pause in this initial Delta surge. Then maybe it gives us a little hope. If this starts to continue to move higher, that's a very good thing for stocks. If we see this as kind of a false break higher and we see this stock bond ratio go below this declining trend line, that would be a bigger warning sign that maybe we're going to see a pause in the S&P 500. Maybe it's going to chop sideways for a little bit, or maybe we're going to see a 5 or 10% pullback kind of in the fall at some point. So another one that does have some value, looking at this comparative ratio. Another way to look at it, we've seen this divergence in different companies that benefited from COVID that did not benefit from COVID. And looking at a couple different areas, semiconductors and cloud computing compared to hospitality and energy, cloud computing with individuals working more at home, companies starting to shift from having physical servers to having offsite servers with different cybersecurity and things like that. Semiconductors and cloud computing, really didn't suffer much at all in the COVID crash and have gone massively higher, 120% higher than they were in late 19. On the flip side of it, travel and hospitality, your airlines, your restaurants, more publicly traded restaurant groups, hotel groups, and oil from probably people, flying less and driving less. Those were really negatively affected. So much so that, oil prices and oil services stocks were down 70% from where they were. Travel and hospitality was down over 50% after the peak. So we have seen this divergence happen. One of the things that we can note here is seeing this Delta surge. We haven't necessarily seen any negative effects from here. We have started to see prices fall in the energy sector and the travel and hospitality. So one of the things that we might be entering into is this period where instead of sort of blanketly, causing volatility and everything selling off like it did in March 2020, people are getting a little bit more comfortable with the effects of the COVID environment. And maybe there's a little more rationale where a rise in cases, we've started to see some people cancel airline flights, cancel some reservations. Oil prices have fallen down a little bit. There's tangible economic harm to these different companies that are negatively affected from lower travel and less kind of lockdowns and things like that, more lockdowns. So we might be starting to shift into a phase where we're seeing this divergence, where that increase in COVID has negative effects on certain parts of the market, and it doesn't negatively affect other parts of the market. that would be a fairly healthy environment to get into from a market standpoint, a little bit more rational approach to it. If a company is going to have revenue decline, their stock price should go down. One of the things that this tells us right here is that we could be potentially entering into that phase, which would be kind of a more rational, healthy, as it relates to stocks phase of COVID. Last one we'll look at from a relative standpoint, which I found incredibly interesting, is looking at the 30-year yield versus airline stocks. And they're almost identical. So if we go through since late 19, the orange line is the ticker JETS, JETS. It's publicly traded airline companies. It's an ETF. And the blue line is the 30-year Treasury yield. And they have just absolutely been identical. So, they should be, they're different assets. They should be performing 100% differently. They have, 30-year yield has to do with Fed movements and global interest rates. And it's such a massively different beast than airline stocks. But the market is treating it all and lumping it all in together. And this is a performance chart too. So this is looking at the actual increase and decrease in percentage terms of these stocks versus the Treasury yield. And they've been absolutely identical. So if you're looking at Treasury bonds, which have correlated more to COVID, a rise in Treasury bonds means a decline in yields. A decline in yields, we're probably going to see those hospitality, oil, jets, all of that sort of be lumped into one kind of basket and perform very, very similar. So you can almost pick any one of those out and kind of have a pretty good idea of what these other parts of the market are doing. It also says that if you're relying on some traditional diversification, you're probably not going to get it. I mean, stocks and yields airline stocks and Treasury yields shouldn't be identical. But they are. That's the phase that we're in. So we thought this was kind of interesting to see those perform so in line. And the big question is why? Why are these different things happening? Why are stocks not responding to COVID when it should make a difference? Why are airline stocks performing so well, performing so identically with yields? And our last chart, it's the Fed. We've talked about this for a year and a half. And if you've read any of our newsletters, insights, which is on our website, we've been talking about this for quite a while now. And what this looks at is the Fed balance sheet versus the S&P 500. This is from our friends at Real Investment Advice. So the orange line is the Fed balance sheet. Starting in the financial crisis here, so this goes back to 2003. The black line is the S&P 500. This orange line starting in 2008, Ben Bernanke started to really flood the market with liquidity. And for the most part, there has been a very high correlation with the Fed balance sheet, how much assets they're printing and buying in the market and flooding the market with this artificial liquidity. There's been an extremely high correlation between the Fed balance sheet and the S&P 500. And as long as the Fed keeps massively injecting liquidity into the system, until this relationship changes, it's causing these different assets to perform similarly. It's causing the S&P 500 to have lower volatility than what would probably make sense in a normal environment. And you can see the extent of it. They went from, $3.5 trillion balance sheet in the end of 19 to almost an $8.5 trillion balance sheet now. So they're putting 80 to 100 billion a week into the financial markets, and it's causing markets to go up. At some point, this is going to stop. At some point, there will be consequences to it. but the market is telling us that at some point, it's not today, it's not yesterday, it might be tomorrow, but until we see some kind of real tangible difference in the market's response, I don't think we should expect a whole lot different. And at this point, the Fed is starting to talk about taper. That is important. If you're looking at anything, it's not COVID cases, it's not earnings, it's not economic data. If you're going to follow one data point, follow the Fed. That's going to have a bigger correlation to what future stock prices might be. And right now, they're still flooding the system with liquidity. We will talk about potential consequences of that in a future episode, but for now, I think we just need to watch the Fed, and the Fed is still printing, and that's why we're seeing low volatility. So thank you for listening. This has been Strategic Growth. You can follow us on our website, ironbridge360.com, my email, jim.denholm@ironbridge360.com. Please do not hesitate to reach out with any specific questions. We'll be posting this deck on our website, and follow me at Denholm_Jim. And with that, look forward to seeing everybody soon, and invest wisely.